So thank you very much. We will go ahead and get started by introducing the speakers today. We have a distinguished set of speakers. I'll start by introducing Mr. Sri Padmanabhan. Mr. Padmanabhan made most of his career at the Reserve Bank of India, where he last held the role of executive director. He was at the forefront of developing India's agent network regulation, and he'll be sharing some of that experience with us. And he remains on the board of several state financial institutions in India. We also welcome Maureen Gerard. Maureen Gerard is a project lead at Boston Consulting Group. She was also previously at MIT Sloan and Google. She will be sharing with us a recent work, a very detailed work that BCG conducted with the Bill and Melinda Gates Foundation to design a global playbook on developing hypotheses on interventions to drive rural expansion of agent networks. And we also have with us Jeremiah Grossman. He's Deputy Director at BFA, Bankable Frontier Associates. Jerry has worked with a variety of public and private sector stakeholders to promote the development of safe and enabling legal and regulatory frameworks to foster financial inclusion. I welcome all of our speakers, and I'll introduce myself. My name is Emilio Hernandez. I'm Senior Financial Sector Specialist here at CGAP, and I've been leading our current programs around cash-in, cash-out networks and agent networks at the last mile, as well as all our work related to revisiting the impact of financial services on the lives of the poor. We'll get started with the agenda today. We'll be making a short presentation to share with you a recent work that CGAP has put out that really compiles the global experience on developing distribution or agent networks to foster financial inclusion. Now, as part of this work, we really revisited the question of why are distribution networks key to financial inclusion, and starting with are they? And what we found from the global evidence now, after maybe 15 years of the evolution of digital financial markets in many developing countries, is that cash-in, cash-out agent networks seem to be a critical step for uptake and use of digital accounts by people. So not only the uptake, but also the usage increases as your networks expand, right? And further than that, it's not just a correlation. We see from many data points around the globe that there's a causality. So there's this perhaps counterintuitive situation where you need to expand the cash-in, cash-out infrastructure for people to start using digital financial products, and for that market base of digital financial users to scale, right? And we also present in our guide a little bit of what we know how that actually happens, where in countries where cash is still used for many income and expense related transactions that people have, when you introduce a particular digital finance product that digitizes one of those many income and expense transactions, you're necessarily going to need a cash-in, cash-out point for people to move between cash and electronic money back and forth, right? So not to distort their other remaining cash transactions. Now, as more and more people are able to use those digital financial products, the market base expands, and we see that providers are motivated to keep diversifying and adding digital financial products that digitize more and more expense and related transactions among people. And it's only until, for most people, most of their income and expense related transactions are digitized that you actually see cash-in, cash-out networks become less relevant. Now, if you look at all the countries around the world, basically you see a and you analyze the cash in, cash out infrastructure as documented by, for example, the BIS, um, you see that cash in, cash out infrastructure increases very rapidly in emerging markets where the digital financial markets are starting from a low base and they start growing side by side with Kiko. Now, in more mature digital financial markets, cash in, cash out infrastructure kind of plateaus or stagnates. And there you have the experiences of the United States and most of the European Union. And actually, we don't see in many countries, maybe just 3 countries for the data that we have, where cash in, cash out infrastructure has actually declined in countries like China, Norway, or Sweden, where you got very well developed digital financial markets that have achieved just that. They have achieved digitizing most income and expense related transactions for most of its population. So it's a journey, right? And that is why when we're talking about digital financial inclusion, Kiko agent networks seem to be critical. And that proximity with an agent enables um, customer trust because these are agents that are close to customer communities and the information that they give can be trusted by clients. So this is the process of why we wanted to explore the question. Then why is it that we see so much clustering of cash in, cash out networks or agent networks in urban strongholds, and we don't see expansion into more rural areas in many of the developing countries that we work in? So CGAP started this global assessment of all the different cash in, cash out agent models, and of course, this is a topic that's been working for that the industry and the development agencies have been working for a very long time, and we have the incumbent models like the ones that we see from banks, for example, and agent banking networks. We have now what we would consider incumbent MNOs, mobile network operators, and their agents providing financial service as well. But we also see a recent emergence of a new generation of Kiko agent networks, mainly led by um, third-party companies acting as agent network managers, like OXXO in Mexico, like Celcom in Tanzania. You've got agent network managers like Baloto in Colombia that are being very successful at creating this, using agents as an open platform that many service providers can use. And you also have firms like e-commerce companies and fintech companies that are developing these e-platforms, linking them up with these agent networks, and they themselves acting like an agent network manager that connect all of this vast number of agents digitally to different service providers. And more, you see that the type of service providers that these agent networks aggregate, you know, are not only related to financial services, they're also related to non-financial services, like commerce, like transport, like trade. Um, and what all of so we have very different models, and the most successful models we see use different strategies when it comes to expanding their agent networks, and that is very much subject to the market context, right? Um, so, for example, you see some of the lead banks and MNOs still being able to achieve significant expansion, like in Kenya, Zimbabwe, for example, some parts of Indonesia, that they're able to generate these networks by being successful at diversifying the services that they provide directly, right, through their agents, and they may keep those agents exclusive to their offering, but by diversifying the use cases, what that does for the agents and the customers is that it increases the likelihood of more transactions per customer. And as you move away from rural areas in that spectrum of rurality that exists, um, those agents that are in more rural areas where there are fewer people in their service areas because in rural areas population densities go down, with more transactions per customer, they're able to generate more revenue and be able to become the likelihood of them being viable improves, right? So MNOs have achieved, some of the lead MNOs have achieved it, the banks as well, but these new players are achieving that same principle of aggregating services for more transactions per customer at the agent level in very different ways, using very different strategies. And so we're pointing out the emergence of these new models and contrasting them with some of the incumbent models. Um, so what are the implications of this? Well, what what this aggregation of services that we're seeing is that it's pushing lead providers to link their services with other services. Either they come up with additional services that reinforce the offer, like starting for payments, for example, and moving into credit or insurance. But we also see aggregation of financial and non-financial services, like you start with actually e-commerce and trade or transport services, and you start linking it with payments and then credit and then insurance, right? Among others. And so what this does is that, well, it can increase the value for the customer as you can reach an agent and be able to use a wider variety of services. And many times those services reinforce the value of each other. So for example, let's say I want to buy a good on an e-commerce firm. I have the option of paying digitally or asking a credit to buy for it. So these products and services are complementing each other, which raises value and, of course, raises usage as well. Now, this aggregation also comes with certain risks that we see, especially for today's topic, which is policymakers and regulators' role, where the more activity, the more functions agents plays raises the risk of abuse, right? And so customer protection dimensions of these new models are very interesting. Now, having said that, there's been a lot of progress both by incumbent and new players in terms of expanding their agent networks. There are also, it is clear that the last mile, those really remote rural areas, remain a challenge, right? And this is where we see public-private collaboration being key to be able to make it viable to make agent networks reach those remote rural areas, right? So going back a bit to the work that CGAP has done in the past a little bit over a year on this topic, we set up a consultation process where we really reached out to all of the different industry actors as well as regulators and policymakers to see in a way, see the big picture on what were some of the ideal Kiko network characteristics that you would want to see globally, even if you're using very different strategies to achieve that ideal scenario. And as a goal, we came up with this statement of, what an ideal Kiko network looks like, which is a Kiko network that allows existing and potential rural customers to have access to a Kiko service point that viably provides them with convenient access to desired financial services in a timely, trusted, and safe manner. So there's a lot of very important dimensions in this goal that relates to viability, relates to reaching the customer with services, with many services of value, and that those services are delivered in a timely, trusted, and safe manner. Um, so with this exercise, we put forth 6 principles that we see the most successful agent network models achieving um, that kind of come as a result of these strategies to aggregate services at the agent level. One is that it enables the Kiko agent to generate more revenue streams, and that is critical for viability, especially in rural areas. So we see that those models that are successfully adding not just any service, but services of value really increase the number of transactions per customer and help a lot in making those rural agents more viable. At the same time, that allows then the expansion of agents into rural areas because they see um, acting as an agent as an interesting means of making a living, and that allows agents to be more closer and accessible to rural customers, as well as those strategies developed, as you expand into rural areas, in most developing countries, um, the 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 structure of the local economy changes, and the actors change a lot. So, as in maybe in urban strongholds, you can rely on registered businesses that have a fixed physical address to be your agents. But as you move into rural areas, you start these players are finding ways to viably work with semi-formal shops and merchants, or individual entrepreneurs who can act as agents, and they can move around and operate in a more cost-effective manner in that rural economic setting. Like I said, there's the issue of managing risk, and some of the lead players have also found ways to manage the risk posed by those rural areas, and they've been able to do that without hindering that innovative drive to expand into rural areas and work with different players, right? Um, this refers to the ability of regulators and policymakers to allow this process of testing and learning. The providers test and learn with different agent network models and in managing those risks, and most importantly, identifying what those risks are, not just hypothesizing and acting on hypothetical risks, but actually monitoring carefully to see what are the revealed risks, and then acting upon that analysis. Now, these models of service aggregation have also come hand in hand with um, lead providers being able to see more holistically the different actors that they're engaged with, seeing more holistic the transactions of the agent and also the transactions of the customer, because they're providing more and more services linked to different type of agent and client activities. So that holistic view allows providers over time to innovate and be able to respond to new customer needs, and that fosters inclusion, especially when you're talking about um, um, closing the gender gap in the use of Kiko. So including women who have, in most countries, not in all, are using less financial services overall, are using less Kiko agents, and are more tend to be more financially excluded. And like I hinted before, the other part is um, the expanding into the really remote rural areas. We don't see even the most innovative models reaching there without collaboration with governments. So public-private partnerships seem to be key in achieving this presence in the last mile in a viable manner. So this is to give you a bit of a flavor of some of the big picture messages that we've been able to compile in this global assessment. And in the guide, we go further in providing and proposing certain recommendations for policymakers and regulators on what they can do to speed up this process, right? And to create an enabling environment. But to discuss those specific recommendations, we will be chatting with our guest speakers who have direct experience in um, in all of these topics from different parts of the world. So I'd like to start with perhaps Mr. Sri Padmanabhan, and of course the other speakers can chip in. But there's this one particular question around some of the principles that allow that aggregation of services that we were talking about, and that expansion into beyond the urban strongholds, which is in these new models, we see more and more that agents are interoperable and they are non-exclusive and they're non-dedicated, meaning that agents can perform transactions for different financial service providers. That's interoperability at the agent level. Um, they are non-exclusive. They don't need to work only with one financial service, and they're not dedicated, meaning that they don't necessarily only need to give financial service. They can also be supporting other type of businesses and transactions. However, as I said, we see different models, and on the one hand, perhaps you got the case of China, where it's perhaps one extreme where you see agent networks that are completely open to any provider to use, full agent interoperability, non-exclusivity, and it works in that market setting. Perhaps the other extreme is countries like Kenya or Zimbabwe, where lead MNOs have closed agent networks that are remain exclusive and not interoperable at the agent level, because that's the way they've been able to ensure and motivate the investments to keep them increasing and diversifying their product offer. And perhaps in between, we see countries like India, where the regulator has allowed exclusive agents, but those agents, let's say, the accounts of the customers that agents serve are fully interoperable, right? So it seems that we've got these different strategies, and in different markets, the level of agent interoperability and exclusivity changes. And I wanted to hear, actually, from all three speakers, their perspective on what are some of the key considerations from a regulator standpoint on the right balance on agent exclusivity and agent and account interoperability. Perhaps, Mr. Padmanabhan, would you like to start?
Yeah, thank you very much. Good morning. I think I'll take a couple of minutes to explain how India went about this process of enrolling business correspondents. The process started in 2006, and it was fairly limited. I think in any of the opening up that India has done, any of the sectors, I think we have gone about in a very calibrated manner. So this was initially opened up only to the business correspondents were open. Those who could act as business correspondents were only the NGOs or the microfinance institutions, or basically the non-profit organizations. Prima facie, the consideration right from the beginning, and which remains an issue even today as far as the central bank is concerned, given that the Reserve Bank is a full-service central bank in the sense that it also has to take on account the customer protection issues also. I think the way this got opened up was that then it got opened up to the non-profit making companies, then to the small shops, etc., and finally, based on the various committees that worked on this issue time and again, sometime in 2012, Reserve Bank of India opened this to the big companies, the corporates also. Having said that, what it ensures is while a corporate VC can work as a VC for multiple banks, at the customer touch point, the agent who works on behalf of this corporate can work only for one institution. The reasoning that the central bank has is that probably given the size of India and the kind of length and breadth, there may not be too many institutions at the rural level or at a block level. But more importantly, even if there are more institutions, the worry is that it could result in misselling. So while directly right from the beginning, the Reserve Bank of India was conscious enough to not to intervene as far as the commissions, the payments, etc. were concerned. This was one aspect that Reserve Bank insisted upon, and as we speak today, this situation has not changed. So while multiple products are possible, and as far as when I say multiple products in India, what business correspondent is allowed to do today is a microcredit, is a micro insurance, is a payment, and deposits. These are the four things that prima facie is allowed to do today. And at the customer level, what has been truly made interoperable is the payments. So if you are having a facility to do payments, you can do payments on behalf of any customer, any bank, etc. But as far as the deposit, the credit, etc., is concerned, which is of critical importance, even today the regulation says that at the customer touch point, you can be the agent of only one bank. And this has one more implication. Let me flag that and then probably stop. Is when you say that you can be an agent for different banks, but it has to be sort of firewall. Basically, this means that in terms of you are having to keep the security deposit or being able to avail of a credit limit, etc., for meeting out these payments. There is a segmentation that happens, and in finance, we know that the more it is segmented, it gets less efficient, and the scaling up becomes more difficult. So you will have to keep separate accounts, margins with each of these institutions that he is dealing with. So this is again one issue which is there. But other than that, I must say that the scaling up has happened dramatically over the last few years. Neither the government or the Reserve Bank of India, while giving very high-level guidelines, and not intervene, thankfully, into the micro-level payments possible. In fact, the only intervention Reserve Bank did was to make sure that when there's a three-tier structure, where I mean that there's a bank, there's a big corporate, and then there are sub-agents who are working at the ground level, the Reserve Bank made sure that what goes to that person at the ground level is at least an X percentage of the commission that is paid out, although the banks had the full freedom based on their board decision to pay out the commission, so that the agent at the ground level is reasonably compensated. This is how the regulations are moved as far as this country is concerned.
And Mr. Padmanabhan, just to clarify to our attendees, what was the main, or what is the main argument and motivation of RBI to maintain that exclusivity when it comes to financial transactions such as credit and deposit at the agent level? What is the main concern?
The concern is the mis-selling. That based on the commission that gets paid out, you may probably bring more business to a particular bank as against another bank. It's another matter we could argue at an international level whether this should be the concern of the regulator or the concern of the bank boards. But in this country, as I said, since the regulator is responsible for the customer service also, the view had been taken that there are possibilities of mis-selling. So at the customer touch point level, they can deal with only one institution.
Thank you. I'd like to call out Jerry. Jerry, what other type of experience have you seen in other parts of the world related to approaches the regulator has taken on this topic of interoperability and exclusivity at the agent level?
Thanks, Emilio, and thank you all for the opportunity to participate here. I think that when we look at things like interoperability and agent exclusivity, we certainly need to look at each country individually and try to understand the particular country context and the stage at which each country is in the development of an agent network and development of digital financial services and digital payment infrastructure. So when you think about things like agent exclusivity, on its face, exclusivity creates barriers to competition, but you could also argue that in early stages of development of a digital financial services market, that allowing for at least temporary or time-bound exclusivity might serve as a reasonable incentive to encourage providers to put in the investments that are required to identify, to train, to manage networks of retail agents. And we have seen that in a number of, particularly in some of the markets where mobile money has developed across Africa, where in the early stages of the market, agent exclusivity was permitted or was not explicitly prohibited, But over time, as those markets began to develop and it was seen as an anti-competitive mechanism, or a mechanism whereby it made competition more difficult, either regulators stepped in, or a competition commission stepped in, or a provider would take a case to a court and the court would rule that exclusivity was not permitted because of a barrier that it created to effective competition. And when we think about this in the context of the last mile rural context, I think that you again have to look at the country context, but on its face, I would say that exclusivity could present greater risks. In those kind of environments, you probably have a much more limited supply of retail agents that really have certain characteristics that you require for a successful cash in and cash out network, like the cash management skills, the technical capacity, access to a bank account, really having the capacity to provide those services effectively. And if you do allow exclusivity in that kind of environment, you do run the risk that first movers may maintain an advantage and really hamper and limit competition. So I think that when you start to move into the last mile context, you need to think very carefully about that, particularly if you don't have the type of interoperability at the account level and the ability for anyone to transact with any agent. Right. And then I guess finally, on the question of interoperability, I think everyone agrees that's where we want to go and where we need to go. But then the real questions are, how soon do you do it? Which model do you use to do it? And what role should the regulator play and the private sector play in moving in that direction? I think that is something that needs to be looked at very carefully based on the country context, rather than trying to take one approach and apply it across all different countries.
Right. And Jerry, in those countries where you have seen the industry and regulation evolve into more interoperable and non-exclusive agent networks, how do you address some of the issues raised by Mr. Patty on mis-selling? Have you seen any strategies to avoid that?
Yeah, I think that there are legitimate concerns, and part of it, I think, comes down to how a country or a financial authority wants to strike the balance between what it deems as its responsibility to protect customers as opposed to trying to foster competition in a market. Certainly, I think that putting in place effective mechanisms for ensuring proper disclosure of costs of different services, putting in place requirements for proper mechanisms for customer complaints, and even creating mechanisms that enable customers to submit complaints directly, particularly nowadays that we have different opportunities in terms of adoption of technology for customers to be able to go directly to the central bank or submit complaints to the central bank if they feel that either an agent or a provider has mistreated them or has misrepresented things to them. I think that one approach is the approach of, okay, we're not going to allow this because we're concerned about mis-selling, and that seems to be more the Indian approach, which is to try to avoid the problem from arising. Another approach could be to create greater flexibility, but then ensure that customers have more access to information and greater recourse in the event that things do go wrong.
Right, and probably the way to achieve those mechanisms of customers submitting complaints will vary a lot from context to context. That would be the root solution in some of these contexts where agents can be made interoperable and non-exclusive, right?
Sure.
I'd like to ask Maureen. Maureen, would you have any reactions to this question on agent exclusivity and interoperability?
Sure, yes, and I'll try to keep it very short, but overall very much aligned with what Jeremiah just said, all the points. I think, from our perspective, the study we conducted was very much in-field primary research at the agent level, and so just wanted to add in the perspective that from an agent point of view, at least in our sample across 4 markets, Kenya, Tanzania, Bangladesh, and India, the non-exclusive agents had significantly higher revenues, were able to generate significantly higher revenues, up to 40% versus exclusive ones, which really meant a big difference in terms of establishing economic viability, especially as we look to less densely populated areas, so rural and frontier areas. So I think, we're fully aligned with having non-exclusivity and interoperability as a North Star there. That said, of course, from a regulator's point of view, granting temporary exclusivity, whether it's limited in time or limited in a geographic area, you could also, set up different providers that each focus on a different province of the country, for example, at the beginning, to help them generate enough revenues and profits that they can justify the investments in rural expansion could be an interesting policy lever. And a good example of that was in Pakistan, the digitization of the Benazir Income Support Program. The government initially partnered with one provider and a few providers, each dedicated to different areas, and then over time opened up more and more the market, which led to a successful program that has lived in time, but has also expanded the agent network coverage in the country. So that's the only point to add from our study. But of course, I'm mindful of time. Could expand in Q&A if needed.
Thank you for that. Yeah, so it seems like there's a journey, right? It's not it's probably not an abrupt imposition on the industry. The way to go in terms of forcing agent interoperability and agent non-exclusivity. There's a natural journey that the market and the providers should take, but the benefits in terms for the customer and for the expansion of these agent networks of achieving agent interoperability and non-exclusivity allow or facilitate this aggregation of services that we've been noticing among the lead agent network providers, right, which has tremendous implications on the agent economics and on the value that the customer perceives on the different services that are being offered to him or her. But perhaps going in this trend and touching specifically about some of the risks that we have already hinted at. So we have in this newer models or the leading agent network models in terms of coverage, agents that are performing a lot more functions than we've seen in the past. To take a bit of the extreme example, at the beginning of the mobile money revolution in East Africa, for example, we saw, and we still see in many places, agents that just do cash in and cash out transaction. That's the only thing they do. Now we see agents that are doing slightly more, agents that are providing marketing services, agents that are allowing the process of loan applications or helping open an account or providing client advice on terms of the different product offer that there is. So the more functions that they do from a regulator perspective, that raises an eyebrow in terms of their potentials for abuses, right? Mis-selling, as we have just heard. But they're also like to talk about what you have seen in terms of some of the best practices that you see the industry or the regulator or policymakers take to avoid fraud at the agent level, attitudes or activities that relate to monopolistic practices of keeping some of the players out, and ways to actually receive and monitor complaints around reported abuses by customer, or aspects as related to know your agent requirements, which are also quite important when assessing the risks of what an agent can pose. I'd like to perhaps ask Jerry, maybe you'd like to start?
Sure, thanks. And there are a lot of different topics here that we can touch on. I think that maybe just to start with, we can talk about some of the core basic good regulatory practices that we see across many different country regulatory regimes when it comes to addressing the use of agents. And one of the standard requirements that we see in most countries is that the principal, the provider of the services, is held responsible for the actions of an agent conducted on its behalf. And really ensuring that the provider cannot get out of accepting responsibility for something based on the fact that it was its agent that did it as opposed to the principal itself is really one of the core basic requirements that ought to be in place. And the vast majority of countries do have that in place one way or another, but I think that is a really important place to start. Beyond that, most regimes that cover branchless banking or electronic money issuance or use of agents ensure that the providers are subject to consumer protection regimes, and ensuring that some of those mechanisms are in place in terms of proper disclosure of terms and conditions, of costs, ensuring that proper mechanisms are in place for customers to submit complaints and for dispute resolution. And then, as we started to see over time, more and more mechanisms for customers to be able to go directly to, say, a financial supervisor with their complaints. So we see, for example, cases such as in the United States, the Consumer Financial Protection Bureau put in place a consumer complaints database that allows them to collect complaints and then submit those to the providers for resolution. They publish anonymized complaint data. In the Philippines Central Bank has been testing a chatbot-based tool for collecting and processing and addressing customer complaints, which was a prototype of that tool was developed through a donor-supported project called the RegTech for Regulators project. In cases like Brazil, we have supervisors using media and social media to identify key concerns and to be able to zero in on areas where we're seeing greater concerns about fraud and abuse. And then just very briefly to touch on this issue of monopolistic practices, I think that that gets back to this question around exclusivity and how that can limit competition and reinforce monopolies. And that may be a bigger issue in rural areas, as I mentioned. And we have seen over time that there have been a number of different ways that those monopolistic practices have been challenged. But one of the things that we're also starting to see now is in countries that have recently put out regulations governing branchless banking or e-money issuances that monopolistic or anti-competitive practices are being directly addressed in the regulation, and that's actually used as a precondition for assessing a potential application for a license.
Mm-hmm. Thanks, Jerry. I'd just like to remind our attendees that they can start submitting questions at any time through the chat box. Please be sure we'll be monitoring your questions as we go along. So picking up on one particular point that you made, Jerry, making the provider or the principal, as we call them, responsible for the actions of the agent has been a very important condition or criteria for regulators to impose. Now, some of the things that we've seen in different parts of the world is that some of the way they have implemented this principle may vary. For example, we see in countries like Indonesia where the regulator is so concerned about this that they are very wary of allowing agent network managers, meaning a third-party company that acts in between the principal, the bank or the digital finance service provider, and their agent network. Because they're concerned that there won't be enough accountability between the provider and the agents on the agent's actions, right? Given the meddling of this third party. Versus you go to countries like India, like Mexico, like Colombia and Brazil, where agent network managers are very well accepted and embedded into that legal framework that enforces accountability on providers and and their agents. I'd like to ask Mr. Patty, and of course other speakers may have can have a change. How did the regulator in India view this issue of agent network managers, and how does this affect the accountability of the banks on agent actions?
Thank you, Emilio. I think the way India went about it's in a way interesting because although there were initially a set of guidelines of sort of onboarding the agents, I think initially when the whole thing was started, to make sure that you are able to supervise the work of the agents effectively, the Reserve Bank did have a guideline which said that the nearest, because initially it started for the bank, so there must be a branch within X kilometers, or a branch can have a set of agents only within a periphery of X kilometers. This was put as a part of regulation to make sure that there is an effective supervision. Although I think, as Jeremy said, India also said that right in the beginning that the principal is responsible for all the actions of the agent. So, but at the same time, there were ecosystem which was thought best by the central bank created to make sure that the supervision is effective. And as technology took on, actually these things were relaxed one by one. For instance, today the distance, which if I remember, it started with something ridiculously low number of 6 or 8 kilometers periphery or something, that got expanded once the technology came on. The other issue is that the consumer protection were very well laid down right at the beginning. There was an ombudsman scheme, it was already working. And once the technology took over, Reserve Bank recently came up with what is exclusively for the technology-led all this financial inclusion and others, which is a digital ombudsman scheme. So that was also put in place to take care of the consumers, the protection, their complaints, etc. Finally, the Reserve Bank actually ensured that there were the institutes which they could influence, starting programs for training these various agencies and agents in the aspect of financial inclusion to make sure that they understood the work or the seriousness of the work they were expected to do. I think through these methods, I think this has been fairly straightjacketed as far as India is concerned.
Thank you. I'd like to pose to a new and the last topic that I'd like to discuss with you related to the need for the need that we see in most countries that we looked at of public-private collaboration, right? To be able to viably expand agent networks to the very last mile. This remains a big challenge, and I'd like to start asking Maureen some of the insights that they were, BCG was able to collect and looking at what are the most effective levers that government can use to help the industry expand into those remote rural areas.
Yeah, sure. Thanks, Emilio. So maybe a little bit of context, one line of context. So this is a study that we conducted over the last year, and the idea was to do a global landscape of policy levers that are used by regulators and policymakers to expand Kiko services in rural areas. And it's all publicly available online, and it was 55 plus case studies, and we looked across markets, both developing and actually developed markets as well, as to how regulators have enabled the spread and the access of to financial services to marginalized or to remote and rural communities. We've also looked across industries, so not just Kiko, but also financial services more broadly, and also other services like telco, utilities, etc. So just wanted to ground a little bit what I'm about to say. And so, based on those case studies, we've essentially identified 12 specific policy levers and that we categorize roughly in 3 big categories. The first one is inclusion mandates and service obligations, where a regulator can create the impetus for providers to expand service. So it can be a mandate, especially for state-owned banks, but it can also be coverage targets, thresholds that are included as part of government contracts for the provision of a service, like digital benefits transfers. The second bucket then is around what we call profitability improvement levers. So that's when a regulator or policymaker helps providers and agents either increase revenues, and this can take the shape of income guarantees for agents, investments or R&D subsidies for providers upfront, governments taking on investments in infrastructure as part of contracts, or it can also be around reducing costs. And the most extreme examples perhaps that we've seen there is in Brazil and Peru, where the government actually leverages the military, for example, to deliver and transport cash to remote areas to rebalance the agents there. And finally, the third big area of levers that we've seen is what we call demand generation or new use case creation, where the regulator, the government can either subsidize, fund, or create an innovation sandbox for providers to come up with new use cases to serve specifically rural or remote communities, or the government can also outright decide to digitize, for example, government-to-person payments and transfers, which creates kick off a market pool or demand for Kiko services, especially in rural areas. And so, having said that, a few overall remarks from the studies, and of course there's more detail behind it, but of course there's no one-size-fits-all situation. So we've seen, commenting on like the effectiveness of those levers, and perhaps the natural question is which one of these is most effective or we've seen work best. So the answer is it depends. It depends on the market context. It depends on the provider and the industry structure. It depends on the level of maturity of the Kiko and the DFS space already in the market, the type of infrastructure that's available as well in rural areas. So it's a highly varying response across contexts. That said, perhaps interesting conclusion from our study is that there's actually no one policy lever that's been used in one market. So what we see, even looking at developed markets over time, how they've expanded their financial services to marginalized or to rural communities, we see that it's really about having a holistic picture for how you want to develop your financial services, your Kiko services, and using your levers in combination and in sequence. And typically over time, we've seen push levers, so mandates, for example, closely followed by pull levers. And so an interesting case there is, for example, in Kenya, the new initiative to digitize a national safety net program is really interesting. This uses a combination of levers as a program where the government not only creates demand for Kiko because it's digitizing benefits, so now you have users that are demanding Kiko services, but it also sets coverage targets for providers, and it also gives providers a different subsidy or transfer price that increases the more rural you go to cover on-the-ground costs for providers. And finally, and then I'll pause here, as you go through these levers, what will be important to keep in mind is that new government and provider collaboration models are super important because they allow government to not set the prices in a vacuum or not set coverage targets in a vacuum, but instead be really grounded in on-the-ground realities. And it's also important to allow for multi-year investments. We've seen failures and failed cases of governments only allowing for 1 to 2 year subsidy programs, when in fact you would need multiple years of development for then the sufficient market pool and demand to be created so that the agents and the providers can ultimately become viable. So I'll stop there, but I'm happy to take any question, of course.
Thanks, Marine. Any final reactions on this topic from Mr. Paddy or Jerry in terms of policy levers? This final thought, very quickly, your key takeaways in your opinion around this topic.
Yeah, thank you. I mean, if you look at the entire financial inclusion as a triple E, where I call enroll, enable, and empower, then I think unless we have that private-public partnership and large companies also corporates come in, I think the second E and the third E becomes very difficult because in India we have clearly seen issues where some of the business correspondents, their break even is so high merely because they will have to also provide the infrastructure to take care of probably the lack of infrastructure that the bank has to make this financial inclusion happen. So I think this is very important. And in a country like India, where cash is still the king, although the digital transactions have been increasing, I think the cash in, cash out suggestion that has been brought out in the report is extremely important because otherwise, what tends to happen is that while the first leg of the transaction happens the digital way, then everything else gets withdrawn in cash because the ecosystem where these the poor or the excluded still live, they do not have the digital infrastructure for them to be continuously using. So whatever Marine said, I completely agree. This is something that we are seeing in India. In fact, there's a question which has come up about the infrastructure where the regulators can manage. I think the typical India example is where the central infrastructures have been put up, is being put up by the government or the regulators like the UPI and others, where several agents can use the same set of services rather than putting up separate infrastructures. Because as technology takes on, I think it is important to make sure that we save on we consolidate the infrastructure rather than putting up individual or non-exclusive infrastructure or exclusive infrastructure. Sorry.
Right. Jerry, any last thoughts on this?
I know we're pretty much out of time, but just really
Yeah.
quick, I think that it's useful to look at the Brazil example just because they have the longest history of working with banking agents, and I think we can learn a lot from the process they went through, both in terms of the incentives they provided as well as the regulatory approach they developed.
Right. Well, thank you very much. With that, I think all of these very useful interventions. There's a lot of food for thought, and there's a lot of resources that has been referenced during our discussions that attendees can go into. We have received a couple of questions which we'll transfer. One of them is coming from an attendee from very familiar with the Middle East context, where he says that can regulators or the government manage infrastructure over investments that will be used by providers working with non-exclusive models. This, I guess, goes to the question about developing infrastructure in a non-exclusive agent model. How does that affect the incentives of providers when to invest in expanding these agent networks if they're not going to be exclusive? And what kind of role government can play to, avoid that lack of investment in expansion because providers don't see a benefit in investing in that if they're not going to, be able to enforce exclusivity. Any reactions to that?
I think that's what I tried to answer because the India's answer to that was there is an infrastructure development fund which has been put together by the government and the regulator, and the government and the regulators keep setting up the central infrastructures where people can seamlessly join and don't directly intervene in this cost so that they can have their own model as far as scaling up is concerned. In fact, given the fact that over a period of time, there has been multi-fold jump in the number of transactions using the UPI. The last I looked at it last month, I think it was more than 1.3 billion transactions. I think that proves that probably one way forward is for the state, the government, to put up certain central infrastructures, because otherwise spending on infrastructures would be an issue.
Right. Jerry, any comments, or Marine, any comments on that question?
Not particularly. No, I think there's a lot of nuances, and it's hard to give a top line answer. But I mean, I can only answer at a theoretical level. I would, which is that you could probably have an agreement. So in the case of the telco and utilities, for example, service expansion in rural areas. So that doesn't necessarily apply to Kiko directly, but there could be learnings from those sectors. There usually is a contract that sharing agreements, basically, with governments covering some of the investments in the basic infrastructure, and then authorizing for telco exclusivity, at least in some restricted area or for some limited time, in order for the telco to recover the investments. I think at a theoretical level, why not have the regulators and the government invest in infrastructure, especially if you decide to set non-exclusivity from the beginning. But I don't have a good example that comes to mind just yet.
Right. Well, thank you very much. We've concluded our allotted time, and maybe just to try to synthesize a bit what we've discussed. It seems that it's the regulator and policymaker role is really is a case by case basis, and it needs to respect and have a good touch on the journey that the financial industry is taking in the particular context, right? To be sure that they set up the incentives and the enabling conditions for the industry to move towards that ideal enabling environment of non-exclusivity and non-dedication and interoperability that allows that service aggregation that increases value and reach. And this we've discussed several levers and tools that can enable regulators and policymakers to achieve that. I thank you very much all for your time. Thank you to the speakers, great insights. I hope attendees enjoyed the webinar. Remember, we have recorded it, and so it will be on the website for you to take a look at and share. And thank you very much, Marine, Jerry, Patty, for your time. And thank you, and have a great day, everybody.
Sure. Thank you very much, everyone.
You know.
Thank you. Bye-bye.
Bye-bye.